Hotels across India, the Middle East, and Africa are full. Occupancy has recovered. Travel demand is back. But here's the uncomfortable question. If hotels are full, why aren't they more profitable? In this video, we're going to break down one simple idea. Why occupancy and profitability have completely decoupled, and what the data from 3 regions tells us about the future of hotel economics. Hotel occupancy has recovered and in some cases exceeded pre-pandemic levels. In India, average occupancy is hovering around the high 60s. In the Middle East, it's comfortably in the 70s. Africa trails slightly, but the trend is clearly upward. On the surface, this looks like a success story. Demand returned faster than expected. Supply remained disciplined. Leisure and business travel both rebounded. If occupancy were the full story, hotel owners should be celebrating. But occupancy is only the headline. Profitability tells a different story. Now let's look at EBITDA margins. And this is where things start to break. In the Middle East, hotels are reporting EBITDA margins north of 30%. Africa sits in the mid-20s. India struggles to cross 20%. This is despite India having relatively healthy occupancy, which leads us to a critical insight. High occupancy does not guarantee high profitability. Something structural is happening beneath the surface. When we plot occupancy against EBITDA margins, the disconnect becomes clear. The Middle East sits in a sweet spot. Reasonable occupancy, strong pricing, disciplined costs. Africa performs better on margins than its occupancy alone would suggest. India, however, is the outlier. Occupancy is respectable, but margins lag meaningfully. This tells us the problem is not demand. The problem is how revenue is being converted into profit. Let's break down the Indian hotel cost structure. 4 line items dominate. OTA commissions, payroll, utilities, brand and franchise fees. OTA commissions alone consume over 20% of room revenue for many hotels. Payroll costs remain sticky, even during low demand periods. Energy costs have risen sharply, and brand fees are fixed, regardless of profitability. The result? Hotels work harder to earn less. Compare this with direct booking share. In the Middle East, over 60% of bookings are direct. Africa sits closer to 50%. India remains heavily dependent on intermediaries. This single factor explains a large part of the margin gap. The more control hotels have over demand, the more profit they retain. Occupancy without control is expensive, so what's the real issue here? It's not demand, it's not travel sentiment, it's not even competition. The real problem is revenue quality. Hotels in India are filling rooms, but on someone else's terms. Until distribution economics change, higher occupancy will simply mean higher operating stress. What smart operators are doing differently? The best performing hotels are doing 3 things differently. Aggressively pushing direct channels. 2, tightening cost structures without hurting guest experience. 3, pricing for profitability, not just occupancy. These are not tactics. They are economic decisions. The next decade of hospitality will not be won by hotels that fill rooms. It will be won by hotels that understand their economics. This is hotel economics, where we decode what really drives profitability in hospitality. If this perspective helped you think differently, stay with us. The numbers have more stories to tell.